Chapter 9, Part 2. We're dealing with fixed assets, long-term assets. In Part 2, we're going to talk about the concept of depreciation again and show how we calculate depreciation and how the journal entries work using the three main different methods. So what is depreciation? Depreciation in popular speech means something that's wearing out, it's losing value. In accounting, it's got a very specific definition. It is all about cost allocation. We are allocating the cost of tangible assets to expense, and you have to pick a method that is systematic and rational, and it makes sense to those periods benefiting from the use of the asset. And so we have three different methods, and they are used for three different reasons. Depreciation is cost allocation. It is not asset valuation. In popular language, we would make an equivalence that as it depreciates, it's losing market value. In accounting, those don't always match up because you have many different methods. Depreciation does not apply to land. So we need three pieces of information to start out in computing depreciation. We need the original cost of the asset, and we talked about that in the last video. We need an estimate of its useful life, either based in time or in units. For example, this machine can handle 100,000 repetitions of this one process, or this truck can drive 250,000 miles. That would be its useful life in terms of units. And finally, salvage value. What is the value of this asset at the end of its useful life? And in most cases, the salvage value is estimated at zero, but not in your textbook. Depreciation methods. Your goal in choosing one of these three methods is to pick the one that makes the most sense for the asset. And it makes the most sense because you're trying to match the cost of depreciation against the benefit of the revenue that the asset brings in. All right, I'm going to say it again. Please print out your course pack. I've got a spreadsheet on there that you are going to need to do this following problems. So let's go in. Let's take an example, and you're going to want to write this into your spreadsheet on the top of the page. This is the florist shop, and you're going to want to write in the original cost, $14,000, salvage value, $2,000, and then something called depreciable cost, leave that blank for now, and life, put that in as 5 years, and then kind of squeeze in there estimated driving range. This is a truck, so it makes sense to have the driving range estimate in terms of miles. I'm sorry, it makes sense to have it in terms of miles. Obviously it would be if it's driving range. All right, what I like to do when I teach this concept is we're only going to be responsible in Chapter 8 for booking the depreciation expense, but I like to walk you through the whole transaction. So in the back of your handout for Chapter 9, there's a blank sheet of journal entry forms, and so log this as your first journal entry. This truck was bought January 1st, 2011, and you're going to show this as a debit to equipment. That would be how we charge the truck, and a credit to cash. So we're going to assume that this was paid in cash. Okay. So let's calculate straight line depreciation. Straight line means it's the same every year. So going back to that spreadsheet, original cost 14 minus salvage, depreciable cost is 12,000. We're not going to write off all the 14,000. We're only going to write off 12,000. So you take depreciable cost for straight line, you divide it by its life of 5 years, and you get $2,400 per year. All right, so underneath that you have a spreadsheet, and write in these titles: depreciation expense, accumulated depreciation, and book value. And you have 5 years of life on this truck. You are going to write off $2,400 a year every year. So please note, under date of purchase, You have $14,000. You have the original cost, not the salvage value. I'm sorry, not the depreciable cost, but the original cost. This purchase date was January 1st, so at the end of year one, assume it's December 31st. You're going to write off a full year of depreciation. Accumulated depreciation is only for the first year, so you have the same amount. Book value is a calculation. You take the original cost minus the accumulated depreciation. Now, I want you to pause the video and fill in this chart on your own without looking at the solution. Now remember, depreciation expense will be the same every year. Accumulated depreciation, however, will grow, and book value will steadily go down until year 5 when it's 2,000. So take a minute and fill that out. All right, here's the solution. First year, second year. And finally down to the last year. Fill that out on your own, and you're going to have another practice problem coming up that you'll be doing on your own. All right, go to that journal sheet in your handout, and I'd like you to log in the first year's depreciation, which actually will be the same for every year. So please note, this is the first year, and actually it's every year, but the date will change, and it's going to be as of December 31st, debit depreciation expense, and credit accumulated depreciation. Now at the bottom of your page, you'll see some T accounts, and I'd like you to take a minute and fill out those T accounts as well. So under the equipment account, you only have one posting, and that's a debit on the left side of $14,000. Under accumulated depreciation, the first year, you're going to have a credit of $2,400. And under depreciation expense, you're going to have a debit of $2,400. I've only given you T account, those 3 T accounts. You don't need to book the cash account because there's so many items under cash. Okay, let's go to units of activity. So turn back to your spreadsheet. Again, we have pretty much the same facts, except we're going to calculate depreciation as a form of per mile. Okay, so write this calculation in on the side of your page. We're going to take that depreciable cost, because that's all we want to write off, and divide it by the 100,000 miles that we estimate that this truck's life is good for. 12,000 divided by 100,000 works out to 12 cents of depreciation per mile. Now this method is great because you're really matching usage to depreciation. And this is a very logical method to use for a vehicle. You just check the mileage at the beginning and ending of the year and you're good to go. However, this means you will not have the exact same amount every year because it would be just about impossible to drive exactly the same amount. So let's fill this in for all 5 years. 15,000, 30,000, 20, 25. And you're going to see that every year you have a different amount and you will have a different amount of depreciation. So for the first year, you're going to have 15,000 at 12 cents a mile. That'll be 18,000. And the spreadsheet's filled out pretty much the same way. Then you'll go to 30,000, and of course that'll be double. So this will be $3,600, and of course depreciation expense will grow from here. So take a minute, stop the video, and fill out the rest of this chart on your handout. All right, here are the solutions. And remember, when we did this for straight line, the depreciation expense was identical every year at $2,400. Okay, now you see this 12 cents a mile doesn't change. This is the one that changes, and of course that means your depreciation expense changes. We get through the 5 years and we end up with salvage value again. In my example, all of these miles add up exactly to 100,000, which is very convenient. So let's book the first year journal entry. Again, you already have, just put this on that same list. and just write in the current year depreciation expense. And make sure to put descriptions on your journal entries so you have them for later use to book 1 year depreciation using units of activity. All right, declining balance. This is a very different method. This is what they call an accelerated depreciation method. So accelerated means faster, to go faster. So declining balance is used when you want to write an asset off faster. And the theory is, in using the declining balance method, is that you get the most benefit from these particular assets at the beginning of their life. In other words, the older the asset gets, even though it has a 5-year life, the less benefit it brings the company. This is particularly useful when you're writing off technology, computers, that sort of thing. So the method looks very similar to straight line, but the whole goal of declining balance is to write the asset off as fast as possible. So let's take a look. The declining balance is double the straight line rate. So let's do the straight line rate. And the straight line rate is calculated as a function of its life. So for example, we had a 5-year life, so the straight line rate is 1/5 every year, or 20%. If it were a 4-year life, the straight line rate would be 25%. If it had an 8-year life, the straight line rate would be 12.5%. Whatever the straight line rate is for that particular problem, you double it. So the first year for declining balance, we're going to write off 40% of the asset. Now there's another twist to declining balance. At the beginning, you don't use the depreciable cost. You use the original cost. So when you start out with declining balance, you ignore salvage value. This is a way to make it even a bigger number so that you write off even more of the asset. So let's see if you can fill out that spreadsheet on your own. Let's give you the first one there. Okay, so let's talk through this. With declining balance, the name also helps you figure out how you're doing this. So for the first year, you have the original cost, but it's a declining balance problem. So for the second year, you're going to start out with that 8,400, which rolls over from the book value at the end of the first year. All right, so we're still using 40%, but it's 40% on the declining balance. We'll show that again for the third year. Now, there's another twist with declining balance. Declining balance says, yes, you ignore salvage value at the beginning, but you simply cannot depreciate the asset beyond salvage value. So, if we took 40% of 3,024, that would calculate to a higher number, which would have taken us below salvage value. So you must stop depreciating it when you reach salvage value. And so even though this truck has a 5-year life, we stop depreciating it at the end of the 4th year because we reach salvage value. So the 5th year, we get a free ride. We don't depreciate it at all. And then at the end of the 5th year, it's at the end of its useful life. So booking that depreciation expense for double declining balance, it's also called double declining balance, would be 5,600 depreciation expense and credit accumulated depreciation. So I hope you've written all these journal entries down because you're going to be referring to them as you go forward with the homework and with the exercises. So let's look at these 3 methods. Straight line, same amount every year. Units of activity, it varies. And declining balance is really quite high the first few years, and then it gets actually lower than the other methods. So if you look at declining balance, you write off a great deal of the asset the first year, and then it gets lower and lower. Straight line is just what it says, the same amount every year. And then units of activity varies. And it's very typical, particularly with startup companies, to have units of activity be pretty low the first year because you have less customers. And then as the word gets out, your sales might grow, and so will your use of that asset. This concludes part 2. Let's go on to part 3.